Okay, friends, very good morning. Let's continue the discussion on case studies. I request everyone quickly move on to case study number 16. Look at what they're talking about. Okay, BG, a corn and wheat processing company, has decided to introduce a new product that can be manufactured either by capital incentive method or a labor incentive method. How many production process they given kanna? Two. One is capital incentive, second one is what kanna? Labor. The method chosen will have no effect on the quality of the finished product. Whether you are going with the capital incentive or labor incentive, okay, there will be no impact on quality. The estimated cost for the two production methods are given below. So look at what they are talking about. Okay, direct raw material cost per unit the given, direct labor, variable overhead, total fixed cost also the given. BG sells the new product at 60 per unit. 60 is what selling price, and 60 per unit. Okay, during the initial phase of product life cycle, incremental selling expenses are estimated to be 10 lakh annually plus 4 per each unit sold. Kana 10 lakh is a fixed karna, $4 per unit is what variable, regardless of the manufacturing method. Fixed costs are all directly traceable. Incremental cost. Kana fixed cost they are talking about what kana? Incremental cost they are talking about. Incremental fixed cost is relevant or not relevant? Relevant. When deciding which manufacturing method to use, the company management team take into account the operating leverage. Now look at point number 1. Calculate estimated break-even point in the annual unit sale for the new product if the company uses the capital incentive method and labor incentive method respectively. Show the calculation. Can I simply BEP they are asking us to calculate. BEP in unit, what the formula kanna? Total fixed cost divided by contribution per unit. So look at, put the heading, problem number, case study number 16. Case study number 16. Case study number 16. Below that, point number 1. Calculation of break-even point in units. Calculation of break-even point in units. Calculation of break-even point in units. Below that, first arrow mark. Calculation of contribution per unit. Calculation of contribution per unit. Below that, 3-column table. Your table should comprise of 3 columns. First column, particulars. Next one, capital intensive. Next one, labor incentive. Capital incentive. Next one is labor incentive. Under particulars, record small a. Small a. Selling price per unit. Selling price per unit. Both the columns record 60. Next one, small b. Variable cost per unit. Variable cost per unit. Variable cost per unit. One by one consider kanna. Direct material. Capital incentive 10. Labor incentive 11.20. Next one, direct labor. Capital incentive 12. Labor incentive 14.40. Variable manufacturing overhead. Variable manufacturing overhead. Capital incentive how much kanna? 6. Labor incentive 9.60. Next one, variable sales overhead. Variable sales overhead. Check out the below para kanna. Selling expenses 10 lakh annually plus 4 per unit. Therefore is fixed or variable kanna? Variable. So both the columns record 4. Next one, total. Calculate capital incentive. 10 plus 12 plus 6 plus 4. How much you are getting? 32. Labor incentive. 11.2, 14.4, 9.6 plus 4. How much kanna? 39.20. small c, contribution per unit, within bracket a minus b. Calculate 60 minus 32, how much करना? 28. 60 minus 39.2, how much you are getting? 20.8. Capital incentive contribution per unit 28, labor incentive 20.8. Correct? Next one. Leave one line gap. The record small Roman 2. Otherwise, second arrow mark. Break even point in units is equal. Break even point in units is equal. Total fixed cost divided by contribution per unit. Total fixed cost divided by contribution per unit. Below that, capital incentive is equal. Capital incentive is equal. Check out करना. Okay, total fixed cost. Manufacturing fixed cost for capital incentive how much करना? 48,80,000 plus fixed selling how much करना? 10 lakh. All divided by contribution per unit 28. Calculate 48,80,000 plus 10 lakh all divided by 28. For the break-even point in units करना 2,10,000 units. This one labor intensive is equal for the fixed labor incentive करना 26,40,000 plus for the fixed selling करना 10 lakh divided by contribution per unit 20.80. Calculate 26,40,000 plus 10 lakh all divided by 20.8. How much करना? 1,75,000 units. 1,75,000 units. Correct? Yes or no? Next one. Look into bit number 3 करना. Okay, point number 2. Calculate annual unit sales volume at which the company would be indifferent between two manufacturing methods. Indifference between two method means indifference point. How to calculate करना? Difference in fixed cost divided by difference in contribution per unit. At that level, whether you are going for a capital incentive, labor incentive, both will cost the same. So record. Point number 2. Indifference point in units is equal. Indifference point in units is equal. Indifference point in units is equal. Difference in fixed cost divided by difference in contribution per unit. Difference in fixed cost divided by difference in contribution per unit. That is equal. What is the difference in fixed cost? Check out करना. Difference in fixed cost. करना capital incentive करना 48,80,000 plus 10 lakh how much करना 58,80,000. 58,80,000 minus labor incentive fixed cost 26,40,000 plus 10 lakh. How much you are getting करना 36,40,000 divided by difference in contribution करना 28 minus 20.80. Simplify the calculation what you are getting. Simplify the calculation what you are getting. 58,80,000 minus 36,40,000 how much करना 22,40,000 divided by 28 minus 20.8. How much you are getting करना 7.20. Calculate the number 22,40,000 divided by 7.2. How much you are getting करना 3,11,111 units. In case if your estimated production is 3,11,111 units, So whether you are going for a capital incentive or labor incentive, that doesn't make any difference. Both will give you same cost. Yes or no? Yes or no? Next item. Explain how the level of sales can affect whether company choice or manufacturing method. Check out kana below indifference point kanna the option which carries a lower break-even point will be profitable. Kana in case estimated demand of your product is less than 3,11,111, which machinery, which method of production is advisable kanna? Lower BEP is what kanna? Labor incentive. And in case estimated demand is above indifference point, select the option which has a higher contribution per unit. So which has a higher contribution per unit kanna capital incentive. At indifference point, both will give the same profit, same cost. Below indifference point, select the option with a lower fixed cost or lower break-even point. Above indifference point, select the option which carry higher PV ratio, higher contribution per unit. Sir, why means if you follow that advice, your profitability will be maximum. Estimated demand below indifference point. So when you select a lower fixed cost for a small quantity, you will cross BEP. After that, you start making profit. Above indifference point means the option which has a higher contribution, higher PE ratio. So above at that level, both will remain the same profit. Above to that which had a higher PV ratio, higher contribution will make more profit. So record. Point number 3. Choice of manufacturing method. Choice of manufacturing method. Choice of manufacturing method. Below that, first are a mark. At 3,11,111 units of production. At 3,11,111 units of production. Both the options will offer the same amount of profit. That's why I'm indifferent. Both the options will offer the same amount of profit. Both the options will offer the same amount of profit. Both are giving same amount of profit. I will be normally any choice or indifference kanna. Indifference. Second remark. If estimated demand is below indifference point, then the option which carry lower break-even point, that is labor incentive will be more profitable. Correct, Amma? Next remark. If estimated demand is above indifference point, then the option which carry higher contribution per unit, or higher PV ratio, will be more profitable. Will be more profitable. Is it clear, Kanna? Now from there, capex they are coming to what, Kanna? Life cycle. Identify 4 stages of what, Kanna? Product life cycle. So record the following are the important phases of the product life cycle. The following are the important phases of product life cycle. Below that, first are a mark. List down one by one. Kanna, what are the first phase? Introduction. What is the second phase, Kanna? Growth. Next phase, maturity. And last phase is what, Kanna? Decline. The following are the important phases of the product life cycle. Introduction, growth, maturity. Next one what karna? Decline. Next item. Look into next item. What they are talking about karna? Bit number 5. Identify the pricing strategy that the company might use when the new product is in second stage of product life cycle. Kana growth phase they are talking about kana. So growth phase, so that means your product is growing. By the time market eater like a competitor rival product entry also will be there. Then what strategy? Initially kana can keep a high price. But growth phase like no we are going to normalize at par with the market. So record point number 5. Point number 5. When product is selling, when product is selling in its growth phase, in its growth phase, other competitors, other competitors might release, might release the same product at a lower price, at a lower price, or they might work on they might work on making the product better, making the product better. That means good quality attributes. Full stop. The company might need to work on, might need to work on getting more customers, getting more customers at this page, more customers at this page, which requires more marketing, which requires more marketing and lowering the selling prices, lowering the selling prices, lowering the selling prices. Continuation, the company might adopt, the company might adopt a competitive pricing strategy. The company might adopt a competitive pricing strategy. A competitive pricing strategy. Is it clear, Kanna? Is it clear? Next one, bit number 6. Explain operating leverage and its relationship with what they are talking about, Kanna. Business risk. Kanna, degree of operating leverage. Recollect your section A, Kanna. It measures what, Kanna? The ability of the entity to recover its fixed cost. If you are able to recover fixed cost, you are a profit making. You are unable to recover, you are a loss making. Correct term risk attached with recovery of fixed cost. So record point number 6. Operating leverage. Operating leverage is the extent. Operating leverage is the extent to which the company's operations, to which the company's operations employ fixed operating expenses, fixed operating expenses. Full stop. The greater proportion, the greater proportion of fixed expenses, the greater proportion of fixed expenses used to produce the product, used to produce the product, then then the degree of operating leverage, the degree of operating leverage will be higher, will be higher. full stop. Next para. In the case of capital incentive, method, the fixed cost is higher. Correct, Amma? The fixed cost is higher. Hence, it carries high degree of operating leverage. High degree of operating leverage. Correct, Amma? So fixed cost of capital incentive higher compared to labor incentive. Operating leverage of capital incentive will be higher. Next one, continuation. High degree of operating leverage. High degree of operating leverage carries high degree of business risk. High degree of business risk, and vice versa. When your operating leverage is higher, Kanna, accordingly your total business risk also higher. Correct? Yes or no?
Yes.
So with that we're done with which item, Kanna? Okay, even case study number 16. Correct? Yes or no? Yes or no? Okay, shall we? Okay. Okay, Kanna, stop the discussion here. Rest of the items we'll pick it up in next session. Thank you. Check out, Kanna.